Yeah, so bonds, hey? What's the deal with bonds? If you're following my new investor series, and if you're new to investing, then you definitely should be, you've probably watched a bit of Bloomberg TV by now and noticed that they're always talking about bonds for some reason. And there's a very good reason for that. What happens in the bond market has flow-on effects to the rest of the economy and, by extension, your portfolio. So let's take it from the top. What is a bond? They're actually super simple at heart. A bond is a debt instrument, very much like a loan. Buying a bond can be thought of quite simply as owning a certificate which says the other guy has to pay you back certain amounts of money at certain times. That other guy, which can be called the bond issuer or the borrower, is the person who initially sold the bond, and they have an obligation to pay a fixed amount of money to the bondholder, the person who bought the bond, at fixed times stipulated in the terms of the bond. But usually, the lion's share is paid back at the bond's maturity. The bondholder, on the other hand, who can be thought of as the lender, is the one who stumps up the cash to pay for the bond up front and is paid back later. Unlike normal loans, the lender can change, however, because the bond itself, that certificate that says you're entitled to be paid back, people can sell that certificate to one another at any time. So even if person A is the initial lender, if person B buys the bond off them, then the bond issuer is now making their repayments to person B, and person A is no longer involved in the process whatsoever. So if an entity issues a bond for $1 million maturing in 5 years, that means they are going to pay the bondholder $1 million in 5 years' time. Until they pay that money, they get to keep what was paid to purchase the bond. However, the bond is generally going to be sold for less than $1 million, because money now is worth more than money later. So when the bond is put up for auction, even though it's a $1 million bond, it may only sell for, say, $800,000. That $200,000 gap between the sale price of the bond and the bond's face value is essentially the interest the bond issuer is going to pay the bondholder for the privilege of getting to use their money for 5 years. If you then take that $200,000 of interest, in big air quotes, known as the discount, divide it by the 5 years, and express it as a fraction of the price the bond sold for, you will get what is known as the bond's yield. Unlike stocks, nobody ever looks at the price of a bond. The reason for that is there are loads of different bonds maturing on different dates and for different amounts, and the only thing that anyone actually gives a shit about is their risk versus their annual rate of return. So instead of quoting a bond's price and maturity and forcing everybody to do a bunch of mental arithmetic for no reason, bond markets have made the quite sensible decision to simply quote bond yields instead. This can be counterintuitive at first, because yields are inverse to price. When bond yields go down, that means the bond's value has increased, and vice versa. In bond markets, the down arrows are green, and the up arrows are red. But even though this might be counterintuitive at first, think about how much of a clusterfuck bond market quotes would be if you needed to know the price, principal, and maturity for every bond, and then do a bunch of maths afterwards. I much prefer having green down arrows, personally. Fun fact, in China they actually use red up arrows and green down arrows on their stock quotes because they regard red as the color of prosperity. This has nothing to do with bonds, and I only brought it up to confuse you. Anyway, so that's what bonds are. But why does everyone care so much about them? The historical returns on holding bonds are pretty pathetic compared to the returns on holding stocks. So why do they have so much of the investing world's attention? Well, it mostly comes down to risk. But the relationship between bonds and risk manifests in a couple of different ways. For one, if an investor thinks the stock market is going to fall over the next year, they're probably going to pull their money out of the stock market. But when they do that, they're not just going to sit on that cash for the rest of the year and watch it get eaten up by inflation. No, they're just going to move that money into a less risky asset to get some returns while they wait out the storm. Sovereign bonds usually are that asset, which means that how attractive bonds look can influence how willing the marginal skittish investor is to pull their money out of the stock market. The other thing about bonds is that if you're risk averse, bonds are just less risky on the whole. Bonds, much like stocks, vary wildly in their risk profiles. Bond issuers come in many shapes and sizes. They range all the way from the governments of the world's strongest economies, usually classified as AAA rated sovereign bonds, although the US has recently complicated things by losing most of its AAA ratings recently. And then as you move down the risk spectrum, or up the risk spectrum because it's more risky, you get to bonds issued by more sketchy, marginally profitable companies. These are known as junk bonds, but despite their name, they are not the most garbage bond. Oh no. The riskiest end of the bond spectrum is called distressed debt. The bonds of companies that are either flirting with insolvency or already in the process of being restructured. Usually when people say the word bonds in isolation, they're referring to high-quality sovereign bonds. To help disambiguate, I've noticed that people often refer to corporate bonds as corporate credit, but whether corporate or government, they're all bonds under the hood. Even though bonds vary wildly in their risk profiles, in general terms, bonds are lower risk than equities. Sovereign debt defaults are rare, usually the domain of small, war-torn, or otherwise geopolitically unstable nations. Corporate bond defaults are more common, but when a corporation defaults on its bond payments, it's in such dire straits that its investors are already likely to be facing a 100% loss. When an insolvent company is chopped up and sold off for parts, its creditors, including the people who owned that company's bonds, are paid first. Only once every bondholder has been made whole will the investors in that company see a single cent from the liquidation, unless the bondholders agree to a restructuring, which is definitely a topic for another video. So yeah, there are low-risk equities and there are high-risk bonds, but on the whole, bonds are a safer class of investment than equities. So much so that the yield on the safest bonds, those high-rated sovereign bonds I mentioned, is known as the risk-free rate. This is something of a misnomer because even these bonds are not 100% risk-free, but if you are sticking to the shorter duration bonds, it's pretty close. And the risk-free rate is important because this is the yardstick that all other investments are compared to. And that comparison looks a little something like this. Let's say the All Ords is trading at 20 times earnings this year. That means if you invest $100 across these companies, and we ignore the possibility of growth and just look at the earnings on the shares you own will be $5 in the year. You can also describe this as an earnings yield of 5%. Is that good or bad? Well, that depends. If the risk-free rate is up at 6%, then taking a bunch of risk for a 5% return would sound pretty shitty. You would have to have an expectation of strong future growth to justify doing something like that. On the other hand, if the risk-free rate is 0%, then a 5% return sounds pretty damn good. Even if there's no future earnings growth, you're still going to beat the hell out of the risk-free rate, which sounds like it might be enough compensation to make taking on all that extra risk worthwhile. The amount that equity earnings exceed bond yields is called the equity risk premium. And it's called that because it's the amount that equity holders are being compensated for the risk they're taking on. Now, if you've been paying attention, you might be starting to get an inkling of why bond yields are relevant to the stock market. So if the risk-free rate is 0% and equities are earning 5%, the equity risk premium is 5%. And if, for example, the risk-free rate increases very quickly, then the equity risk premium falls very quickly. Now, equities can grow earnings, and bonds can't. So even with an equity risk premium of 0%, there is still a reason to own equities. However, a drop in the equity risk premium can make equities a much less attractive investment. The flow of money is going to shift away from equities, not because anything changed about the equities themselves, but rather because they have more competition from the bond market, which suddenly looks a lot more attractive. Bonds compete with the stock market for capital, but it's more than that. Sovereign bonds compete with corporate bonds for capital, and with all other types of lending and investment. A change in bond yields, in a way, changes the footing of the entire investment ecosystem. But let's stop thinking about it from the investor's point of view for a moment. A change in bond yields doesn't just affect the people who buy or might buy bonds. They also affect the entities that need to issue them, i.e. they affect borrowers. Issuing corporate bonds is the primary way that companies take on debt to finance investment in future growth. If the yields are driven way up on corporate bonds, any entities that take out new debt are going to be paying way more interest on any debt they take on. This is going to make them much less likely to want to go into debt, which often means that they are forced to scale back investment in their business in a high-yield environment. Or worse, you could be a company that already took on a bunch of debt before bond yields went up, and now you have to refinance at a much higher interest rate. This is a very common way that highly leveraged companies end up bankrupt. So a sudden increase in bond yields also increases the risk of financial distress in the broader economy. When you're a stocks guy, it's easy to get caught up in just comparing stock A to stock B, but it's also worth keeping an eye on bond yields. Not just to make sure you're being compensated for the risks you're taking with your money, but also because bond yields are a barometer of financial conditions in the broader economy, something that can be very important to stay aware of if you're investing in companies that are holding onto a lot of debt. So that's the gist of it. I am not really a bond investor. Making intelligent decisions about bond investing requires you to estimate the probability of default, and if the bond is denominated in a foreign currency, you're also exposing yourself to exchange rate risk. And if the bond is like long dated, you're also exposing yourself to interest rate risk. So it's like a whole thing. And essentially what I'm trying to get at is if you're interested in actually investing in bonds, this is about as far as I can take you. I'm not a bond investor. You're going to need to find your own educational resources from here on out. However, if you were just here for the Value Investors Crash Course on bonds, I hope you found this useful, and thanks for watching. I'll catch you in the next video.